We're live again. There we go. Click the button. Can you guys see me? We're live again for another episode. And today, what are we going to talk about? The NASDAQ yesterday at 4:15 after hours was minus 1.1%. And then earnings came out to the surprise. Tech is doing better than, I guess, forecasted or estimated. And so NASDAQ's up 4% today in one day. 3% plus 1% after hours. It was down 1% yesterday. So it's a 5% swing from 4:15 yesterday to today at 4:15. It had a 5% swing on the NASDAQ in 24-hour period. That's crazy. That's a lot of change in a short amount of time. Now in terms of what else is going on? Oh, Carvana earnings came out today and went up. The stock's up 21%, including after hours today, up 280%, all 400% over the last year and a half. I think it's trading at like a 500 PE ratio. I'm still short. Sucks. Don't look at me for stock advice. I mean, I was right on DJT. I was right on Sonder. I made money also on a couple other small little shorts that I had going. The NASDAQ pulled back 10%. It was great. And then now it's reversing, which is exactly what you expect. You don't short stocks for long periods of time. And if you do, and you get wrong, you got to make sure you risk manage. And yeah, stocks suck. Real estate. Let's turn the page on what's going on in real estate. The Fed came out today and said they are not going to lower rates in the US. In Canada, we've had 2 rate cuts. They're going to keep cutting because the Canadian economy's not doing so well. But the US has signaled to a September cut potentially. It's seeming like a very likelihood they're going to cut in September, their first cut in over a year. We haven't had a cut in a full year. The higher for longer scenario that was broadcast in January, we'll call it like December 2021, the most bearish people ever, like the most bearish, higher for longer, fear-mongering analysts in 2021 December said by 2024, rates will still be elevated as high as they are right now. And everyone was like, no way, no chance, you're a bear. Like, higher for longer will not play out. Higher for longer did play out. We're in higher for longer. Inflation was not transitory, and rates have stayed higher for way longer than I even thought. Initially, when I first thought about it in 2021. By 2022, I was calling for end of 2024. So we're right on track for where I think where we're going to be. Yeah, I think 2025 is going to be, okay, Canada, US. I think Canada's going to cut aggressively in the rest of this year. I think we'll probably get, by spring of next year, by March next year, I think we'll see the 3.99 5-year fixed rate advertised mortgage rates. And when you start seeing that 3.99, 3.79, real estate starts to make a lot of sense again in the threes. I mean, stuff really starts to cash flow. So I'm extremely bullish about that in Canada. In the US, they had a little bit different story than in Canada. Their real estate hasn't corrected in the US. They didn't have a correction. Like in Canada, we had a 25% correction in Ontario. But in a lot of the US, they haven't had a correction. So that's been interesting, just sort of as an observation. The US has continued to chug along as a strong economic powerhouse and largely unaffected. I mean, commercial's been affected a little bit, office and that kind of thing. But yeah, I mean, it's very interesting to say the least. I mean, we look at how things have kind of played out. In terms of, logistics, what's going on in my life, and just sharing with you guys the daily updates, whatnot, or weekly updates, I guess. We have taken on so many units. So I'm so busy with all the things we have going on. And so yeah, that's been what we've been challenged with. So many units we've had to rehab. Our 24 unit in Sarnia was a huge project, and it's finally, wrapping up, which is great. In terms of trying to figure out what's next, I think for us, it's like just keep acquiring, just keep building up the reserves. I am still very, very bullish, so I'm going to continue to buy. I do think that as rates fall, real estate prices will rise with a lag. So I think 2026 is going to just be unreal in terms of where we look at compared to where it was at the bottom of, we'll call it like, I don't know, I would say like December, January was probably the low. We may test it again this winter, but I think with rates falling, it should keep real estate kind of buoyant, if not even rising a little bit. The bond yields have been falling like crazy right now. So we're starting to see we're seeing 4.79% 5-year fixed rate promotions on right now. I saw one that was 4.49 high ratio fixed promotion for mortgages, which is very, very, bullish, I think, for real estate prices. Now it takes time. Like we're going to see the comps of like 2 months ago when things were not as great. We're going to see the comps of those things start closing this summer. And so we'll use those comps, and they won't be good comps. That'll drag values down. It will take time for the stuff starting to sell now to then register as sold, and say if it sells now, it'll probably would close in like September, October, then those comps will drive prices up. So it's a slow process of bringing prices up. We have a supply-demand imbalance here in Ontario, and builders aren't building in Ontario. So Ontario has a real shortage. We have a lot of new immigrants, a lot of population crisis, and we don't have the available inventory. And so in a lot of ways, I think that we're going to see a continued price action increase as rates fall. Ontario is very dependent on low rates. So that's where I think things are at in real estate. What else has been going on? What else is new in the world? I've been working on my fence at my place, which has been fun, building the fence. Yeah, I've just been enjoying the summer. It's been a good summer overall. It's been, been working on some exciting projects. I have an exciting project coming your guys' way soon. It's a $10 million project. I'm going to have an opportunity potentially for you guys to invest alongside with me. I got to figure out how to structure that, but I've been looking at platforms like Addy to have you guys be able to invest alongside with me in projects like that, which would be really cool. It's got I think it can double in value over the next 2-3 years with the rezoning, not even rezoning, but site plan approval of what I want to do with the thing to create potentially 200 residential units. So that's an exciting project. We had some stuff in Florida that's really exciting going on too. What else is going on? There's, our cottage. We're doing a seawall at our cottage, which is really exciting and fun. We're doing a set of stairs going down too, and so that's fun. On a personal level, I guess personally speaking, I was reflecting last night, like 2 a.m, laying there doing my journaling, and I love to journal once in a while, where I look at my goals and I see where I've been and where I'm going, and I look at my life, and I'm like, I'm so blessed. Like everything is just going so great in so many ways. Now, minus the stocks, obviously, minus this little real estate recession we've had, but like in my personal life, things are going really, really well, and I'm super thankful for everything that I have, and I'm trying to be super grateful for all the things that are in my life. And I find the more gratitude I practice, the better I feel about life. And my house is finally, starting to look really good. Our backyard, we're getting it all done up around the pool, and it's been fun. It's been good having, I never thought I would be where I am now, and I'm so thankful that I am where I am now. And the sacrifices that I made several years ago are starting to pay off in spades. And the fact that I do grind, but I don't have to, which is really, really nice. So yeah, gratitude, guys. The message here, I guess, is to think back 5 or 10 years ago, how far you've come, and just look at all the things you've been able to do. And if you've been slowly stacking small wins, they add up in a big way. Doing little things every day adds up in a huge way. So it's super important to be doing all that. Yeah. Hello from Alberta, David. How you doing? Happy Wednesday. Someone says 30-year amortizations are announced. I always thought 30-year amortizations were already a thing, at least in Canada. Corinna says, hello, Michael Ball as well. What are your thoughts on this week's tech earnings? Again, they seem to be pretty strong. Surprised the upside is looking at Meta's earnings. Again, I think that we have had a bit of inflation, and there's a strong economic powerhouse of activity going on in the US, which I think benefits tech in a lot of ways. It gets businesses to spend more on ads, et cetera, so forth. So the big tech should do well on the face of, there's a lot of AI advancement. I think there's a lot of hype. And so even if things are selling at, crazy ratios, there is still good profitability there. So I think the valuations are too rich for tech right now. I think that people are overpaying per dollar of earnings, but the companies are solid. They have solid cash positions. I can see how people are fleeing to big tech as a place to park capital, almost like you'd park it in gold. Because when you have a solid, AI is the future, and when you have a market monopoly on where people spend their time, that has real value. And so time is a currency. And that's really what tech is trying to do, is trying to make things more efficient and control where we spend our time and how we spend our time and the devices in which we spend our time on. So again, I can see why it's a safe place to park capital, but I don't see, your Apples or your Meta. I don't see them, Meta's $500 a share. I loved Meta. I loved Meta, $100 a share. I had tons of shares. I sold out 125. I think Meta is overvalued at $500 a share. I just don't think they're there yet. And I think people are paying for things that haven't happened yet, and I hate to pay for things that haven't happened yet. I like to create the value. I like to buy it for what it is, and I like to unlock that value. I love a stock that has the potential to run and grow, but I don't want to pay for that growth that may not happen if any market competitors come in and eat their lunch, or we go through another recession. We're in the longest inverted yield curve in history. Sorry, to clarify, is another way of saying that is it is cheaper to borrow money for a longer period of time than it is to borrow money for a short period of time. It should never be cheaper to borrow money for a shorter period of time. You want to incentivize longer projects. Like if I borrow money from you for 10 years, I should pay more for it than if I guaranteed to borrow the money for 1 year. It makes no sense that the yield curve is inverted. It doesn't bode well for the economy. It doesn't stimulate the kind of growth we want. We want people to lock in for long periods of time, but with an inverted yield curve, you get the opposite. And it has never in history not resulted in a recession. So this will be the first time, maybe, where we take an inverted yield curve and don't have a recession following. Typically, when rates start cutting is when the recession starts. If you look at all the data, we're actually going into a terrible time economically. The cutting of rates is only when the economy and jobs and a lot of the JOLTS reports are all negative. You need that weak softness in order to cut. So people are excited about cuts, but like in the actual economy and probably for tech, it's not actually a good thing as they cut because it's a weakening, softening economy. And usually it's on the back of like tons of mortgage foreclosures and tons of businesses near insolvency. They cut because they have to. So it's typically a symptom. The cutting is a symptom of a root cause recession problem. So I guess we'll see. There's always an exception to every rule, but there's never been an inverted yield curve this long, and there's never been an inverted yield curve that didn't result in a recession. So are we going to get a recession when? I don't know. Is it 2025, 2026? When do the lagging effects of these cuts and the damage that these raised rates have caused, when does that rear its ugly head? How long until we feel the effects of, we've had rates higher for longer. We've had 3 years of really high rates, and that should have bankrupted more people than it has. And so I think a lot of those bankruptcies are still coming. There are a lot of people hanging on with maxed out credit cards, et cetera, so forth, that even lowering rates won't save them. The ship is headed for an iceberg and it's going to crash. So anyway, suffice that to say, I do still think that the world will not end and that you should invest carefully in a balanced portfolio. I love real estate still as an asset class. It's a great business. I think buying businesses right now, you can get some really good deals because there aren't a lot of people with capital. At the same time, for some reason, there's an excess of capital flowing into the Magnificent Seven. And the top 20 biggest companies in the world are getting a ton of capital because, again, they printed so much of it in 2020, 2021. So it's sort of interesting to think through how the capital flows through in different market cycles and different business cycles. And we're in a cycle right now where people are fleeing to the big tech because they think it's safe, like they think it's gold. Because again, these companies have massive cash positions in their balance sheet that's super safe. They don't have a lot of debt, and they're super solid iron giants that are largely unaffected by recessions in the same way that you might think. So I can see the narrative and the arguments that the bulls are making for these new all-time highs for the NASDAQ. And I try to listen to what the bulls are saying and the bears are saying to try to find out what makes any sense, right? And it's somewhere between what the bulls are saying and what the bearish analysts are saying. Somewhere in the middle is where the truth is, right? We have no idea what the future holds. All we can do is do our best to gather as much data as we can and continue to pivot and be fluid. If you're wrong on a decision, you need to move on that quick. And that's a mistake that I'm weak in that area. It makes me a terrible trader because I get so much conviction towards my ideas. And trade serves me well in business because I'll keep going. But you need to be able to pivot quickly and make changes quickly. And so I'm trying to get better at that every day. And that's advice for you guys is like, make sure you can change quickly. If you find a strategy isn't working, change and do a different strategy. Hi, Mike. On a value multifamily, is there a standard price per door that you should try to buy at? I would say it depends on the market. Like Randy, it's so hard to give you, it's so hard to give you like one rule, right? So in some markets, I can give you rules. So for instance, in Sarnia, $100,000 a door. In rural areas, $100,000 a door is what I want to pay because market rent is $1,200 for an average unit. So you're at like 1.2 times rent or like a little over 1% rule in terms of getting the value of the property back per month in rent. So if you can get 1% of the property value back per month in rent, but you go out east or to some of the more tertiary markets in Canada, and you should be able to find stuff at $50,000 a door. Or another way of looking at it is a 2% rule. in some of those more tertiary markets. You go into the US and some of these Midwestern states where there's just not a lot of strong economic activity and it's not highly coveted by investors in the same way that it is in like New York or California. If you go into those smaller tertiary markets, like, you know, go down to like Georgia and you go to like some random town, you can find stuff that's like a 4% roll, 5% roll. You can find 30 cap, 40 cap rate properties. So there's definitely those kinds of opportunities that exist. But again, there's so much risk with that. Some of those properties haven't appreciated at all in 10 years. Zero appreciation. There's no demand for the land. So you're just buying the building and you're fighting off depreciation of the building every year with your cash flow. And so you might sacrifice appreciation for stronger cash flow. And those are considerations you have to look into in each market, and every market's different. Some markets, I'll look at properties and, you know, in Florida, in Daytona Beach, I'll find stuff at $100,000 a door. That happens all the time. See stuff, but you go down to Naples, Florida, or into Miami, and you won't find stuff at $100,000 a door in the same way, right? There's just a different premium you pay and different rental market too. Like in Miami, your rent is going to be 50% higher than it is in Daytona Beach. So your property prices should be 50% higher. I think in general, Florida, you know, in terms of what it offers and what it is, I like it as a place to invest. I think there's a lot of great things about Florida that make it special and coveted as a great place for an investor and just as a place to live as well. And so I like to own property in places I like to be. And so for me, I don't want to be in like Ohio. So I don't buy property in Ohio. I don't want to ever go to Ohio. I don't want to go to Cleveland. I don't want to go to like, you know, random area in Georgia. Because again, like for me, it's just like a lifestyle thing. It's not just about making money for me. It's also about like the lifestyle around it. And so that's maybe a consideration that other people don't have. Maybe they're just trying to build a fund. They're trying to run at it. For me, it's like, I like to touch and feel my real estate. I like to go and visit it. I like to go make sure things are good there. When I need to hire new staff or upgrade things, I like to go there and touch and feel it. And you don't have to do that all the time, but occasionally you have to do that. And I don't occasionally want to go to a random place in Pennsylvania, you know, twice a year. I don't want to do that. So it's lifestyle, right? For me, it's like, I'm at a point where I want to build a business that is conducive to the life that I want to live. And for me, that's doing some stuff, but not doing so much that I'm going to places I don't want to be and doing things I don't want to do. And that's okay. Like I have to kind of accept that, like, and there are times where I'll make those sacrifices. Like I'm taking on a couple big projects right now. We're acquiring a few more hotels. And so we'll have six hotels in the portfolio. And that's a big step, you know, it's going to be a big change for us to take on these extra units. And there's going to be some sacrifice for my wife and I to do that. But at the same time, we're like, okay, does this new income mix in with our goals? Like, what do we want? And so we make a 5-10 year plan. Are we okay to make those sacrifices to get that? Some sacrifices I'm not okay to make, right? Like I don't want to buy a property in Toronto, as an example. I don't like to go to Toronto. It's not a place I like to go. Thankfully, the numbers don't work in Toronto anyway. So it's a win, mutually agreeable. I don't want Toronto. Toronto doesn't want me because the numbers don't work there. So that's an example of like where it just doesn't fit, right? But for some people, they like Toronto. They want to be there. They like the smog, they like the energy, like the car theft. You know, they love the constant drain of energy. If at 7 o'clock at night, everyone's still working. I'm trolling a little bit on Toronto. I don't know. It's you know, teach their own. I like smaller towns. That's just, I'd rather be the big fish in the smaller pond than be a guppy in a giant ocean. And that's just me. I like having that control, my pulse on a market, and where I can have impact in that market in a sizable way. It feels a lot better to be the big dog in town than it does to be a guppy that no one knows in a big town or a big city. That's just my personal preference. But yeah. Good to hear you looked into Addy. Yeah, so I haven't actually talked to anyone, David. I would love to, if David, you can connect me with someone to talk to. I have a project that's a perfect candidate for that. And my understanding with Addy, and I don't know it 100% yet, but I believe it's 25 grand for the memorandum. And then you give 5% of the entire project up to Addy as a raise fee. So I would pay like a 5% lender fee, I guess, so to speak, which is actually really expensive terms, but it can make sense to get access to all you guys who want to invest a small amount, like $5,000 or $10,000 into a project and let it ride, or even $1,000. Because like $1,000 for most people is nothing. It's like, oh, I'll throw $1,000, get a 9% fixed return, or 8% fixed return, or 10% fixed return, and plus some equity upside. Cool. Like it's a lot easier to raise that. But the cool thing I think about Addy that a friend of mine brought to me today when I was talking to them, they're like, the big thing, because it's really expensive to raise capital in that way, but the big thing about it is that it builds a track record where you guys, because I already have a lot of investors that have worked with me that know that they've made money with me, but to see that publicly that say 100 of you guys all invest 10 grand or something or whatever. All those distributions going out every month and a history of payment. It's nice to be able to point to that and say, hey, look, this is a $10 million project that I did. I raised $3 million on Addy. You can see all those people made a great profit. Here was distributions paid every month. It's just nice to be able to go to as I grow into a fund or something, it gives me those extra options. And so it's something I'm looking into and considering. If you guys would be interested in that and you would invest in that platform, let me know, because I want to hear if it's worth me spending that money to throw a property up on there to get you guys to invest with it, because there's a lot of cost to build a memorandum and all the legal ease that goes along with being able to offer a property on Addy Invest as an equity investment. You guys could jump in on and use that to crowdsource some funding for the project. So it might be something that I'm looking into. It would be kind of cool to do, just like for an experience. And I wouldn't maybe offer up 100% of the property. I'd maybe offer up like 30% of the property or something and use the capital to develop it or something, or build another building on the site. I'd have to think through how I would structure it, but I'd want to have a clear, tangible ROI that would more than justify the cost of doing so. But I think it'd be really cool resume builder, so to speak. And so if someone asked a question, what's your ideal lifestyle? And are you already living it now? I don't know if a lot would change. If you gave me a lot more money today, I don't know what I would change drastically. Like I might get a little bit nicer house. I might, get a little bit nicer car. But does that make my life any better? Am I any happier in a different setup than I'm in now? I don't know. Really, I don't need to be frugal at all. Like I have a surplus of wealth. We can eat out whenever we want. We can do a lot of whatever we want. And those minor expenses have really no impact on the trajectory of my net worth. When you're getting started, those things matter a lot. But I'll put it in perspective, like someone who's got like Bill Gates, who has $1 billion, if he spends $1 million personally consuming, like he just drops, he just drops like $1 million, let's say, on like going to the club or something, right? You're going to be in a situation where that has no effect on him at all. Like $1 million, he could burn $1 million just like throwing $100 bills everywhere, and it has no effect on Bill Gates' trajectory at all. It's like not even a rounding error. Like it's a 0.0001% of his net worth. And so your personal spending becomes such a little percentage of your overall spending. Your business spending becomes your largest expense, which is investing in people, investing in infrastructure, building out your companies. That becomes the most important. If you spend your time, instead of focusing on getting a good deal on something, personally, on personal spending, you spend your time getting a better deal on your investments and managing your investments better. That is a much bigger, like 5-10-fold impact on the bottom line. And so I've been very cognizant of that fact and telling myself like, hey, you need to be less frugal, Mike, and you need to be more focused on outsourcing and optimizing your current net worth. And so that's been a big like mind shift for me, because the things that got me to where I am aren't the same skills that get me to the next level if I want to go to the next level. And again, like who's to say the next level is better? I know people who are wealthier than me that are less happy than me. So wealth doesn't necessarily mean you're happier. I think at a certain level, it does add some, like up until you get financial independence, where your expenses are fully covered by your passive income. I think up until that point, money is very incrementally increasing your happiness. There's a new study I was looking at that actually goes in the face of everything that I studied when I was going to Western in 2010, 2011. I was studying the psychology of happiness. I took a course on it. And neuropsychology was my minor. And I remember reading about like how up to 100 grand a year, whatever, you saw increases in happiness, but after a certain point, there was no increase. Now, a new study shows we've become such a materialistic society in North America that they survey people at 100 grand, 250 grand, $1 million a year in income, 5 million a year in income, and people are just reporting more and more happiness the richer they are. Like straight up, just more happy in life. So I guess that's a late stage capitalist thing that exists in our consumeristic society, but more money actually does make you happier. But as long as it doesn't come at a great cost, right? So where they found the pitfalls were people who were working like 100-hour weeks, super stressed out, taking anything to the extreme in terms of like sacrifice to get that money, then they weren't happy. So in and of itself, adjusting for the number of hours worked, more money makes you happier. But if you have to work a lot for that money, not necessarily that much happier. It depends on the cost you have to give up for the money, because money is just a way of trading time. It's like a currency to value time. And each person's time is worth different, right? Some people's, and this like sounds shitty to all the communists and socialists watching. I'm sure they'd be like, there probably are no socialists and capitalists that watch me at this point. But let's be honest here. Like you probably already turned it off. You're a socialist or a capitalist or a communist, because I'm a capitalist. That said, I have a heart. Like obviously I believe in charity, and I believe in a lot of things around, trying to balance the scales in certain ways. But I do believe certain people are better than others and they deserve more. And I think that's a necessary requirement. I don't know any billionaires who don't believe that they deserve more, that are competitive and want more and believe that they deserve more. Alex Hormozy says it best. Most of this ultra successful people have a complex where they believe they'll never be good enough, but at the same time believe they deserve more and are better than other people. So it's like they're constantly striving to have more and they'll never be enough. And that's necessary. The ability to delay gratification and focus on the future. So people ask me, like, what is the number one thing, Mike? Like, is it IQ? Is it, ability to be frugal? Like, what is that secret that gets you there? And it's like, well, no, because I know lots of people with ultra high IQs who are broke. And I know also lots of people who are super frugal who have nothing because they don't make any money. So it's like, it's a recipe of many things that coming together that, and I think the number one thing is probably, if I had to put my money on one thing that would make you, it's not even just hard work. Like I want to say hard work, but it's not even hard work because I know people that work really hard that are like cleaners that make like 20 bucks an hour and they work like 50 hours a week, but they have no money because again, they don't save and invest. It's almost like the ability to delay gratification, I think might be that thing that is the difference. Like the ability to sacrifice in all ways to get the end result. And that means like going without, it means working hard. It's all of those things. Like the people who are really good at delayed gratification are good at all of those things. They know that they can sacrifice things now. They're maybe not necessarily frugal, but they'll be frugal for a while to get to the ends, right? They'll do whatever it takes in terms of means. So I don't know, guys. Get a little philosophical here. Saddam says, what do you think about investing in Pensacola, Florida, or near Nashville, Tennessee? Again, like I've never invested in Nashville, Tennessee. I've heard bad things, actually. I talked to a guy who was investing in Nashville and said strongly against it. Pensacola is interesting. The whole panhandle of Florida in that whole area is very affordable. You can buy stuff for $20,000, $30,000 a door in some cases, but the vacancy rate is very high. The challenges with appreciation. You know what? It's not a bad area. I think there could be some. I was looking at some properties, to be honest, up in the panhandle of Florida and even up into like central, up into the panhandle. And there's some good numbers there. I just never pulled the trigger on any deals there, but I saw some really cheap stuff fly through my inbox. I saw like 10 unit buildings for like 800 grand. I was like, wow, that's cheap. I saw like a 40 unit motel for like $1.5 million. And I was like, wow, that's a really cheap price per unit. But again, the vacancy rate was probably like 60%, a bunch of bums, low income. You'd have challenges with that property, I'm sure, that are not captured in the cap rate accurately. Every seller is inflating their NOI. They're all saying their property management is less than it is. They all say their utilities. They all say, they always understate everything. And property management is often controlled by the owner. So they could just like hire someone for like 4% when it's really 8%, and they're not including all the invoices, et cetera, and so forth. So it's NOI is tricky because you can manipulate the statements. So I have a hard time trusting sellers' NOIs, but you gotta apply a level of sensitivity, you gotta apply some analysis to it and make sure that the numbers they're giving you are accurate. Because I honestly looked at the market and I saw 60% vacancy. And I thought there's no way this guy is 80% full. So you just gotta apply your common sense to the numbers. But the numbers do work. I mean, the appreciation probably isn't as good in those areas. I'm sure that they're not widely coveted by investors, or someone would have picked up that motel that was like 40 units for like $1.5 million already quickly if it was coveted, but there is no investors wanting to invest there. There's no attention, no eyeballs there. It's different than, say, Miami, where there's tons of money and tons of eyeballs. People want to buy property in desirable locations, right? So something to be said about buying in desirable locations, or buying in locations you think will be desirable in the future is a good one too. Cool. David, let's definitely chat about that. Addy is a crowdsourcing platform. Boom, boom. All right. I think I got all the questions answered. Pretty cool. What else is going on in your guys' world? What else is going on in the world that I haven't covered tonight on the stream? Any questions, any burning desires before I wrap the stream up? We're 30 minutes in and I've got a free minute I'm willing to give to anyone who wants to jump in a question. You're watching live right now. There's 40 of you guys. Does someone have a question they want to hop in and do? It'll be the last question of the day here. Someone's typing. They're typing fiercely. Waiting for the comment to come up. What else has been going on? Yeah, the stock market in Canada. Let's talk about that for a sec here. Bank of Montreal was down 17% year to date. Bank stocks being just hammered, just destroyed. So yeah, it's been a wild time on Canadian equities. It's interesting because the U.S. equities have jumped up. Like the Nasdaq's up like 100% off the bottom. It's almost doubled. Or at 507 QQQ price, it was double the bottom of 250, right? So it's crazy in like a less than 2 year span, the Nasdaq doubled in value. Well, at the same time, the Canadian market kind of went down like 10-15%. Most of the big dividend names all kind of hurt because you can get 5-6% dividends from GIC or returns from GICs. Dividends at 6% aren't as attractive. But when interest rates fall and you're investing in your savings account at 1% and your HELOC, you can borrow from your HELOC at 3% again. When the HELOC's at 3%, all of a sudden now buying dividend stocks 7%, there's a spread there. So you can lever up Canadian dividend stocks and it can be really attractive. This last 2 years, it hasn't been attractive to do it. So, okay, I got a couple questions. I'll go fast. Got the live. Hi, Mike. Curious your thoughts on franchising. Thinking of franchising at Domino's. So, Dawn, I guess to answer your question, by the way, thank you for being a loyal supporter of the channel. I appreciate that. See that on there. What else can I say? So franchising, I have found for the most part, hasn't made sense. I haven't seen a franchise where I'm like, I'm all over this. The franchise is almost always best for the franchise. For the franchisee, it's the person who is running the franchise for them. You're often paying a large royalty back to the subsidiary, and that can come at a great cost, and you have little control. In some ways, that can be a good thing, right? If you want to open a sandwich shop, Subway is going to be the go-to because they have that market dominance, they have that brand recognition, they come with a full, easy set of, here's how to do it, how-to guides. We call, in the industry, you call it SOP, standard operating procedures. It comes with all the SOPs that you need. There is, I think, sometimes too much franchising, and people could do it themselves better. But yeah, I don't know. I know a guy who had a bunch of McDonald's and super successful. So, I mean, people do make money with franchises. I think the margins are very slim in most of the franchises, especially at Domino's. I couldn't imagine the margins would be super, super great unless you had an amazing banger location. So really, I think it comes down to location when you're trying to determine a franchise like Domino's. So find a really kick-ass location and maybe it's viable. Do your sensitivity analysis. I think there's a lot of the franchises require the owners to be actively involved in the business. And so that's why I've never gotten into franchises, just because like the return on time isn't good. But there you go. Someone's buying a fourplex in Calgary and renting it out. Is it a good idea? Should you start looking? Again, like it's hard to say that the numbers make sense. I haven't seen the fourplex in Calgary, so I can't comment. But assuming that you can make a strong cash flow and you wanted to be a landlord and you wouldn't mind doing all of the stuff that is required to be a landlord and take on that risk and that stress, it's totally worth it. I mean, you can get great appreciation, you can make great cash flow, but you got to buy smart. So I find if you buy 1% rule, you're good. And Calgary actually has pretty good numbers. It's nothing like Toronto, like nothing like Toronto. And it feels like a big, nice, awesome city like Toronto, but Calgary isn't that. So I like Calgary, loved visiting there. Honestly, great vibe. I could actually see myself living there if I didn't have family here, but I'm kind of trapped here. I got pretty deep roots in the Southwestern Ontario, so I don't think I'll be going to Calgary, but I could. I found it very friendly. I like the city. It's great. So yeah, if you could find a fourplex, if you could find a beat up fourplex for like 500 grand and fix it up, that would be an amazing play. Or buy like a, something that you can add value to. That's where you can get a lot of lift, I think. But it really depends on the numbers. And there's probably a business case to be made, not on every fourplex in Calgary, but in some fourplexes in Calgary, I'm sure that there's ROI. But why fourplex? Why not a duplex? Why not a triplex? Why not a 10plex and get commercial financing? You don't need to show any proof of income personally to qualify for a commercial building. So that's interesting too. Do things never crash in the US? That's not true. I mean, William, I guess to answer your question, things do crash in every market. They just haven't crashed this time. In 2008, the US market crashed 40%, but in Canada, we were largely unaffected. So it just depends on the cycles you're going through, right? Right now, we're experiencing a big recession in Ontario in terms of real estate and just in general. But say Florida isn't experiencing near as much pain. If anyone's watching this, I have a shameless plug. I have a mansion opportunity. I'm going to throw this out there for anyone watching this. If you have an interest, I have a mansion in Florida that I'm a second mortgage holder on that's going through foreclosure that I can buy for 62 cents on the dollar. It's like an 8,000 square foot beautiful mansion. It'd be an easy flip. It'd be a zero down deal. I have financing in place. My ask is if someone wants to do 50% partner with me on it and bring 500 grand for the carry and the renovation, not all at once, but it's gonna be 30 grand a month, 40 grand a month for a number of say 10 months till it's sold. but there's $1.5 million upside. So it's a triple digit ROI. If someone wants to hit up that, if you're ideally a US resident, because then we get the no FERPTA tax holding, there's an advantage to that. Hit me up at rosehartcapital@gmail.com or at Mike Rosehart on Instagram and Facebook. Instagram's probably the best way to find me and send me a DM. Hit me up on that. There's a deal that's in my roster. I'm gonna take it on myself, but I mean, if someone wants to partner up with me, I would love that. It'd be a lot easier on me. I just acquired like 100 units, so there's a lot of cash going out. It'd be nice to have a partner on that, especially if it was a US partner. So hit me up if you have any interest in a Florida mansion flip for $2.7 million, but $0 down. So we take the deal on. My second mortgage is the down payment, so you don't have to put any money down. It would just be covering the carry and the reno with a decent sized upside and a free trip to the mansion where we can work on it together. I'll throw that out there for someone. If you're a US resident, hit me up. Okay, Jimboy 2007 says, what do you think a person just starting out should do with limited funds? So again, I think that when you're just starting out with limited funds, what you invest in isn't as important as what you're doing to build skills and stack skills. At your age, you got to be stacking skills. Super, super important to just find ways to build skills to make your time more valuable. Because if you invest $2,000 and you get 7% return, or you get double the market return, so 14% return, the difference is we're talking on $1,000. That's like $140 versus $70 annual return. We're talking $70 a year difference, whether you get 7% or 14% return in year one. And in year two, it starts to compound, but the point being that a very small amount of capital doesn't matter what you invest in. What matters is building that capital base up. And so I would say if you had a couple $1,000s and you could use that to gain skills to do something where you could invest in a business and invest it in marketing, let's say, and that was able to get you a 200, 300, 400% return, that has meaningful impact on your earning power and on your net worth. So when you're young, I think it's important to invest in your skills. And often if you're an entrepreneur with a side hustle and you invest in your own business, you get a highest ROI doing that. Even if you just learn skills, like stacking skills is so, so important when you're young. If it's like $3,000, if you had like $50,000 or $100,000, maybe you could buy a property or something. If you only have a few $1,000s, you may need to put in your time to get into, if you want to get into real estate, you'd have to partner with someone who has capital, find a deal, bring a partner on, something like that, right? Okay, I'm going to do a couple more questions here. CMHC MLI Select, 95%, 50-year amortization, financing on your fourplex. So I don't know if fourplexes qualify. I know like 5, 6plexes, bigger stuff qualifies typically. I think residential is 1 to 4 units, and then some like RBC will do up to 6 units as residential financing, but mostly it's commercial financing. CMHC is commercial financing. Yes, 95% loan to value in Canada. You can put 5% down. So you can buy a $10 million building that qualifies for CMHC financing and put 500 grand down to control a $10 million asset. 5% down on a 50-year amortization. That is true. That is facts. The only challenges or drawbacks to the CMHC multifamily program, and again, the rates, I've said this before like 10 times in this stream, so I'm rehashing myself a million times, saying the same points again and again, but for those who haven't seen this or heard this, the MLI Select program is awesome because they lend to you at prime -2. They're giving 3.99% deals away. They used to give 1% money away. When rates were 3%, they were lending at 1%. So you go buy a $10 million building in Canada with 500 grand down, and the government would lend you at like 1% interest. It was like almost free money, which caused our whole market to be propped up in many ways. CMHC is government funded insurance that allows lenders to lend really, really cheap to lower their risk, right? But definitely CMHC commercial financing is fantastic. It's very sexy. I wish they would come out and attack something to do with hospitality because I love the hospitality space. They just don't. They play just in the residential space for the most part. Small amount of commercial, but mostly residential. And it's a drawback. I think it would be a huge boon to the hospitality because hospitality serves a segment of short-term accommodation. People they come to Canada, they need somewhere to live for 3-4 months. It serves a sector of the market. And I think we need more of that. So it's interesting. The government's against Airbnb and against all of this. So yeah, I don't know. Just the way the world is right now in Canada. Bunch of dummies running the government, making terrible decisions. What's my take on Windsor and London residential real estate market? I have very little experience on Windsor, but Windsor has been bid up quite a bit. London has too, to be honest. I think London's even getting a bit pricey lately, but there's still value there. Rents have come up. Like prices have come in London since 2022. Prices have come down 20%. And at the same time, rents have gone up 20%. So the spread between rent and price of the home has drifted about 40 something percent. So that makes things a lot better than it was in 2022. The only difference being right now is the third factor, interest rates are really high, but they're coming down. We've had 2 cuts now, down 0.5%, and they're gonna cut probably twice more this year and probably 3 more times, 4 more times next year. So we should see maybe, if we're lucky, at the end of next year, 2.99 fixed rate mortgage offered. For sure, 3.99, 100% will be back. We'll be in the threes. And I think CMHC will probably be offering low threes again for their CMHC products. So that's coming, and that's exciting, and that's bullish for real estate. Now is the time to buy because no one can qualify right now. So if you can get a property right now, I think that in the next 2 years, it'll serve you very well to buy while rates are high. Well, you have very little competition right now because very few people can afford to buy right now. There are doctors who make 200 grand a year who can't qualify. But as rates fall, they'll be able to qualify again, and everyone will lever up. But when rates are expensive and there's negative market sentiment, a number of other factors, it takes time for that to reverse. There's a lagged effect, and I think it's about a year until we see those big changes. So very excited for that. Yeah, thanks everyone for watching. Appreciate everyone. Homeless hair, thank you for that. This is what you call letting it grow, letting it flow. I don't focus on style. What I lack in style, I make up for in heart, in substance. So thank you guys so much for watching. Appreciate everyone who tunes in and watches the stream, watches the replay. Hit the thumbs up button. Follow me at Mike Rosehart, blue check mark on Instagram and Facebook if you want to find me. And of course, we'll see you next Wednesday, 7 to 8 p.m. Eastern Standard Time. Remember the secret to unlocking wealth through you. 3 levers and control your financial future. Spend less, earn more, and maximize returns the difference. That's it, guys. Thanks, everyone. See you tomorrow. Actually, I'll see you tonight on my stories.